Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to this episode of the Australian Finance Podcasts. My name is Owen Rask and I'm the founder of the Rask Group. In this short episode, you're going to hear from Tom Wickenden of BetaShares. In this episode, he's going to give us a rapid overview of an ETF. This episode forms part of a new format on the Australian Finance Podcast where we bring you really actionable, punchy, shorter episodes. If you like this episode and you'd like to hear more from Tom, be sure to write to us. You can find us on the Rask website at www.rask.com.au. Over to Tom.
Hi, my name's Tom. I'm an investment strategist with BetaShares, and I'm going to walk through the Australia 200 ETF today, ticker code A200. So with any ETF, as the ETF provider, we want to make it pretty clear what you're investing in. So a great and easy place to start is the name. You can see here at the top of all, not just BetaShares, but it's the same for Vanguard, for iShares and other providers. They have a really, really handy website with all the information you need. So for our Australia 200 ETF, as I mentioned, you can start with the name. Very simply, we're investing in Australia, so Australian equities, and the 200 in this case means 200 companies. So the 200 largest companies on the Australian market, fairly intuitive. What's really exciting for BetaShares to offer investors is A200 is the world's lowest cost Australian shares index ETF. When we think about a broad market ETF like A200 is, you're investing in the whole Australian asset class. Fees are a really important differentiator, right? If the performance and of different funds do similar things, fees are a really important thing to think about. Importantly too, we also have at the top of our website investment goals. So with the Australian market, we know we get some capital growth out of the companies and also really strong income from some of those companies too, which we'll look at in a second. In terms of the overview, we put some key benefits, which are really important for investors. They can tell you, what are the key things you're getting from this fund. And as we've talked about, you've got that low cost, which is classic with traditional broad market ETFs. Really good diversification. You're investing across 200 companies in the Australian market with a single investment, as well as this one being a flexible exposure. You can use it. I would probably use it as a core building block. It can also be used more tactically just to allocate to Australian equities. Do I get franking credits? Yeah, you do. So as we know, the underlying companies in the ASX pay pretty good dividends compared to their international counterparts. Those dividends come through to A200 with the franking credits, and those are then passed on to the end investors. So on the website, I'll typically then go down to the holdings section just to see what's actually under the hood. And as you'd expect for this ETF, it's holding those really large Australian companies. So you've got Commonwealth Bank, the largest bank in Australia. And you can see the weight here, 11%. So with an ETF like A200, which is a broad market capitalization weighted ETF, i.e. the companies are chosen and weighted by their size, CBA must therefore make up 11% of these 200 companies' sizes. So for every $100 you invested, you're actually putting $11 into Commonwealth Bank. And following down, you've got other big companies like BHP, ANZ, Goodman Group, and Telstra. So those classic companies investors would be used to on the Australian market. So in my books, that's a tick because it's an Australia 200 ETF and the holdings back that up. These are the largest companies in Australia. That's what it should be holding. Following that, we can look at the sector allocation. This might mean as an investor, you have to have a bit of an understanding of what the market is, or it can give you that understanding, right? So in Australia, I know that the largest sectors are financials and materials because of our large banks and resource companies. Well, again, this ETF is showing me 34% of the weight is in the financial sector and 18% of the weight is in the materials sector. So again, that makes sense to me. That's really showing me this is an ETF that reflects the Australian equity market. For context, if we were looking at a US ETF, like our NASDAQ 100 ETF, I'd expect this to be quite different. Within the US market, it's the big technology companies that have the highest weight in the index. So if we're looking at those underlying portfolio holdings, instead of CBA and BHP, we'd be seeing NVIDIA, Apple, and Alphabet. And within the sector allocation, instead of financials and materials, we'd be seeing a much larger weight towards information technology. And the great thing is, just like A200, NDQ has its own fund page, and you can do the same analysis I'm doing now with the NDQ fund. And that's really great for us as Australian investors because our market's quite heavily in financials and materials, not so much weight to technology. The US market is the opposite, higher weights to information technology and lower weights to financial materials. So these two blend really well together for diversification purposes. It's a great advantage of us being Australian investors in the way our market is and the way the US market is. Moving on, another great feature of the Australian market, as I mentioned at the top, is the high income potential. So you can see here for this fund, the distribution frequency. What does that mean? That's how often this fund aims to pay distributions to investors. And that's quarterly for the Australia 200 fund. Now, what's great about the Australian market is these high dividends. You can see here for the past 12 months, it's returned about 3.3% yield to Australian investors and franked up, so including franking credits, about 4.3%. And you can even scroll down to the next section, recent distributions, and actually shows you the cents per unit for the most recent distribution. So it's a great way to see, the income that different funds are paying out. Not all ETFs will be quarterly. Different ETFs can have different distribution frequencies. For instance, all of our fixed income funds, which invest in bonds, they pay monthly. And this is really great for investors because you could have a core equity fund paying quarterly, a core fixed income fund paying monthly, and these blend really nicely together to get income at different stages from different sources. Moving further down the page, you can see we've got some great resources here. So the web page itself is a great resource, but if you want to dig a bit deeper, we've got the fact sheet, which gives you a high-level overview of the fund. We've also got the product disclosure statement. Look, that is important to read. It's got all the information. In particular, section 3 has the fund information, the index information. So I really like to read that. And a little bit further down, we've got related insights. So me and the team here at BetaShares, we do a lot of research on these funds. We put together insights about what's going on in the market at the moment or why you might want to invest in this fund. So those are great, really approachable articles that you can refer to. And look, no matter what you invest in, this is a really important process to go through because ultimately it's where you're putting your money to work and you have to understand what you're investing in so you can understand the likely outcomes that are going to happen from that investment. So look, that's a lot of what's under the hood and some great extra resources. But importantly for a lot of investors, we should look at performance as well, just to get an indication of how it's done historically, albeit not an indicator of future performance. And you can see here on the fund page, we have the long-term performance of the fund, both in a chart that you can change the date range of, which is really handy, as well as comparing the fund to the index it's aiming to track. Now, this is an important concept for investors, but the fund itself will not always have the same returns as the index. It will likely not have the same returns as the index. The main reason typically will be the fees that are charged. But just a good one for investors to be aware of. Have a look at the fund performance, have a look at the index performance, and if it's wildly different, it's probably worth asking the question why that is the case. I hope you found this fund summary helpful. If you did have any further questions on the funds for me or the team, please head to the BetaShares website, reach out to us via the phone or email. We'll always be happy to help.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.